in terms of the strategy, there's two questions you need to ask yourself. It's why and how. Why do I want to do what I want to do? And how am I going to do what I want to do? Okay. So you always should have a bias. Like, you should always have an idea of, okay, this is what I want to do in the market. And there should always be something that tells you why you want to do what you want to do in the market. And it's always very important to follow your rules. Those are the two most important questions. You should have a plan of what it is you want to do on a specific day and why it is. Like, why? Okay, so where do I get my why? I get my why from sequential SMT and just understanding the Asian range and understanding that the London session is usually manipulation. So yesterday, entry in over here, I didn't believe that price would go so high up, but I jumped the gun. This is bullshit. I was not following my rules over here. I had an idea of what I wanted to do, why I wanted to do it. I wanted to do this purely because of the fact that we had sequential SMT. My why comes from SMT, right? We had Euro failing to trade above the fourth quarter of the previous day. And GBP, on the other hand, was deep inside that bitch. This is the high of the fourth quarter of that day, okay? So after you identify your why, you need to find your how. What is my how? All right, I'm going to delete this because I'm just going to shift it one side, actually just delete it. So first off, you have your why. That's your bias. I want to sell today. Then how am I going to sell? Usually how I do it is the optimal trade entry. I should wait for a shift in market structure, which is this line right here. And after the shift in market structure, I want to see price return back into a fair value gap and or balance price range or inverse fair value gap. If we are selling, you'll find your fair value gap above your shift in market structure. This here is my point of invalidation. If price never came back and swept this low and just kept going higher, then this low would be invalidated. So since it came back down this way, I'd be anticipating an entry somewhere around these levels. There's an inverse fair value gap. There's another one here, and there's a balanced price range. There's a fair value gap. And I usually find it using the fib, your 69 levels, your 61, your 70 levels. Usually I'd like the sweet spot, this is the sweet spot. Come on. This right here is my sweet spot. So my fair value gap should be between these two lines, this orange one and the 50%, the 70.5 and the 50%. So in my mind, this is what it should have looked like. This is the most prominent fair value gap that is like present. And we always want to use the 50% level of that fair value gap for entry. And I always use 5 pips as the stop, no matter what. And usually 5 pip matches, like if 5 pips matches like this, then I'm usually confident, about the setup. And in terms of risk to reward, I want to get a 1:3. One position should be closed at 1:3. One position should be closed at 1:5. Another position should be closed at 1:7. And another should be closed at 1:10. But the standard is always 1:5R. So yesterday, I put it. I just sold. I sold and I put a 5 pip stop and I got stopped out. I jumped the gun. I saw the reason why I wanted to sell, but I didn't see my how play out because I just didn't follow the rules, So this is what it should have looked like. This low being swept and the return back into the fair value gap or inverse fair value gap. This is the optimal trade entry. And of course, we also have things like your precision candles, that give you confirmation with, okay, this SMT right here, it should hold. And once I get to 1:10, I'm like, I'm good. I'm good, bro. Yeah, boom. So this is just a way to like split up your entries. 1:5, 1:3, 1:7, and 1:10. After that, bro, what more could you ask for? And here's another thing. Price usually turns around either at the first standard deviation, sometimes at the first standard deviation. GBP was at the first standard deviation. But then if price extends, it usually turns around at the third and or second. So going down, this would be standard deviation 1, standard deviation 2, and this is standard deviation 3. So yeah, that's my why and how. Why do I consider something? I consider it because of sequential SMT and or precision candles, precision swing points. Because precision candles and precision swing points are SMT on a lower time frame scale.